Hi, I'm John Persinos, Editorial Director of Investing Daily. Welcome to my video presentation for Monday, February 5th. To view our full range of products and trading services, visit our website at investingdaily.com. Also, visit the website of our subsidiary, streetauthority.com. The S&P 500 reached another record close last week. The rally is increasingly broad-based, but in the driver's seat are the so-called Magnificent Seven mega-cap tech stocks: Alphabet, Amazon, Apple, NVIDIA, Meta Platforms, Microsoft, and Tesla. This chart tells the story. These seven tech behemoths make up 29% of the S&P 500's market cap. They're also responsible for about 60% of the S&P 500 index's strong rise over the past 12 months. In a minute, I'll take a closer look at the performance during this earnings season of these tech giants. First, here's a quick recap of last week. The main U.S. stock market indices closed higher as follows. The Dow was up 1.4%, the S&P 500 was up 1.4%, and the tech-heavy NASDAQ was up 1.1%. The benchmark 10-year U.S. Treasury yield dipped 0.1%, but remains above the worrisome threshold of 4%. For the fourth quarter of 2023, the blended year-over-year earnings growth rate for the S&P 500 is 1.6%. If 1.6% is the actual growth rate for the quarter, it will mark the second straight quarter that the index has reported earnings growth. After declining to a year-over-year earnings growth rate of minus 1.8% on January 19, the S&P 500 is now reporting year-over-year growth in earnings. That's largely because results are beating expectations. For Q4 2023, with 46% of S&P 500 companies reporting actual results as of market close February 2nd, 72% of S&P 500 companies have reported a positive earnings surprise, and 65% of S&P 500 companies have reported a positive revenue surprise. The technology sector is the largest contributor to this increase in earnings, and the largest contributor to the tech sector has been the so-called Magnificent Seven tech stocks, which have generally produced robust quarterly results with a few caveats. Let's take a closer look at the operating results so far during this earnings season of the Magnificent Seven. Alphabet posted earnings per share of $1.64 versus $1.59 expected and $1.05 in Q4 2022. Cloud revenue beat expectations. Ad revenue missed expectations. The decline in Google ad revenue disappointed Wall Street. Amazon reported its highest ever operating profit for the past holiday quarter, as sales grew significantly in each of its operating segments. Last year's aggressive cost-cutting campaign bore results, as Amazon's operating margin soared from 1.8% in Q4 2022 to 7.8% in the past quarter. Apple released quarterly operating results that beat expectations on the top and bottom lines. Driven by robust iPhone sales and another record in services revenue, Apple returned to growth this holiday quarter after 4 straight quarters of falling sales. However, Wall Street is worried about Apple's prospects for future growth. Revenue out of China, the company's third largest region after North America and Europe, was lower than anticipated, reaching $20.8 billion versus forecasts of $23.5 billion. Sales of the iPhone are falling in China. Microsoft's revenue was $62 billion, a year-over increase of 18%. EPS was $2.93, an increase of 33%. The gains were driven by the cloud. A decade ago, in February 2014, Satya Nadella took over as CEO of Microsoft, following in the footsteps of Bill Gates and Steve Ballmer. Since Nadella took over, Microsoft's share price soared by 969%, beating Apple's increase of 923% over the same period, as well as the share price appreciations of Amazon, Meta, and Alphabet. Over the same time frame, the S&P 500 index increased by 173%. Meta Platforms reported a tripling of profits in the fourth quarter and announced its first ever cash dividend. Meta's revenue rose 25% in the quarter from $32.2 billion a year earlier, reflecting recovery in the online ad market. The Facebook parent is the world's largest social network. Meta ended 2023 with 3.07 billion monthly active users, up 3%, or more than 100 million users from the same quarter a year ago. NVIDIA is expected to report Q4 earnings on February 21 after the market close. In its last report in November, the chip maker's Q3 results blew past estimates, yet again on the top and bottom lines. Tesla's Q4 EPS came in at 71 cents. Analysts had expected earnings of 74 cents per share. And revenue also missed the mark at $25.17 billion versus expectations of $25.6 billion. For full year 2023, Tesla reported delivery growth of 38%, which fell short of its own 50% growth target. As the stock market rally continues in 2024, you can bet on these Magnificent Seven stocks to continue outperforming due to demand for artificial intelligence, cloud services, and other unstoppable innovations. At the same time, the market has been gaining greater breadth, as we can see by the rising New York Stock Exchange Advanced Decline line, the NIAD. And that makes the equity market as a whole less vulnerable to any big tech pullbacks. Now let's take a look at the week ahead. S&P final U.S. services, PMI, ISM services Monday, consumer credit Tuesday, initial jobless claims Thursday. Notably, several Federal Reserve officials are scheduled to speak throughout the week. Wall Street will be parsing their remarks to gain clues as to the Fed's intentions on monetary policy at its March meeting. In the meantime, are you looking to make extra income? You could collect $1,915 or more every month in leftover COVID cash. Wall Street's insiders refer to this hidden pot of gold as the Bank of Biden. Most investors don't know that the U.S. government is sitting on $1.4 trillion in leftover funds from the federal government's pandemic stimulus efforts. Consistent cash flow, month after month, could be yours if you act now. For details, click the URL at the bottom of the article that accompanies this video on the Investing Daily website. And if you have any questions or feedback, please don't hesitate to send an email to me at mailbag@investingdaily.com. Thanks so much for watching.